Hey guys, welcome back to the Mic'd Up podcast. So today we have a very special guest with us, Yong. So he's a licensed financial planner. He's also the founder of mypf.my, and he's going to share with us on how students can better manage their finances. Not only students, if you're adult, you can listen to this too. It's for everyone. Alright, so without further ado, let's get into the podcast.
Thanks so much, Elton, for having me on Mic'd Up. I'm excited to be here, and it's great to talk about financial literacy. I'm not that old as well. Technically, I'm still a millennial as well. So yeah.
Alright.
And broadly, just a general overview first of myself, and then we can talk about financial planners in general as well.
Yeah.
So I'm a licensed financial planner. So in Malaysia, financial planning is actually a licensed activity. So you actually need to get licensing from Securities Commission. And there's actually a separate categorization called the Financial Advisors Representative. So that's from Bank Negara Malaysia, or BNM. So in Malaysia, like in a few other countries like Hong Kong, we actually have a unique dual regulatory system. So we have both the Securities Commission as well as our central bank as being the two key regulators in our country. So on my side, I'm actually regulated for both. So in order to become a financial planner as well, and also a financial advisor, so you would need to have appropriate certification as well. So I hold a certificate in financial planning, or CFP in short, as a certified financial planner. A little bit of background as well myself. So I also hold a master's in business administration. I originally wasn't in the financial line. I was actually in IT. I majored in programming. I went the business side of things. So I was actually employed for a number of years. Initially, my whole life plan was, just to manage my own personal finances, invest a little bit on the side. I started investing in my teenage years. So at that point of time, was actually on my dad's account, actually, because, I was below 18 at that point of time when I started quite a while back. But yeah, then, over a period of time, I was working. I was actually employed for 7 years, but then I took a leap of faith to actually leave employment, and I was just praying for vocation and area to focus on, and I always had that interest in personal finances. So what actually started was that I actually started out a personal finance website or blog. So this was actually way back in 2013 actually. So it's been about seven plus years now. And that website and blog has evolved over a period of time. So it started with just me writing on my own, like called mypf.my, short for people, editors, video editors, even we try to come up with fresh new personal finance content just about every day. So we're actually the top 3 personal finance sites in Malaysia. We get about 100,000 visitors monthly, so about 1 million visitors plus in a year. And then on the other side, wearing on a financial planner hat. So I practice with a firm called Vantage Advisory. It's also one of the top 5 firms as well. So with that, I also continue to meet clients. So in a way, it's really living out, my passion in personal finance, both on the writing, content creation side. And it's great as well. We get to meet people as well. Like, we're having this session over here, cool. Connecting over that. So yeah, that's totally cool as well. And yeah, just getting to talk with people from, all walks of life on their personal finances and financial literacy.
It's actually really, really interesting that you said you got into investing at when you were in teenage years, because that's what a lot of us actually look to get into, but we don't know how, and we end up I feel like we simply just put wherever, this sounds good, this company sounds good, and then we put in money into there. And actually that was what I done, but especially this MCO, all the stocks have been taking a hit, so
right.
Yeah, it doesn't look pretty over there. So yeah, thanks for the short intro. So let's just move right into it. We don't take up too much of your time. So actually, what does a financial advisor do in terms of, actually, what does a financial planner do?
Sure. So that's a good question. So, you talked about some misconceptions as well, or, ideas about, even things like questions like, how to go about investing and all that. So in the olden days, people used to think like, financial planners were like these people that went to serve the rich people who have like millions or billions in their accounts, right? And that's totally not true. Not in today's world. The world has just changed so much, actually. So basically, a financial planner today is someone who actually walks alongside you with your financial journey. So it'll be akin to be a financial coach actually. So it's sort of like embarking on your own financial wellness program that's dedicated, tailored especially for you. So same like you might have a physical fitness coach, or you might go to a gym for engagement. So you can actually engage a financial planner to actually work with you. So it would cover actually everything holistically, from various aspects as well. Because you're right, a lot of times when Malaysians and not only younger folks, even the older folks still remain the same. Sometimes habits die hard.
Yeah.
Sometimes when we invest, it's like, maybe a friend or family member or someone approached and suggested something, or maybe you read about something online and you put a little bit money here, a little bit money there, but it's kind of like rojak everything.
You don't fully understand what's happening.
Bits and pieces.
Yeah.
Correct. Yeah. So the whole idea is to actually give you a roadmap. So to basically have a larger picture in mind, how your overall finance look like, how your overall investment should look like, and then on the right pieces to actually fit into your entire financial portfolio, your entire financial plan. So you cover every things like your cash flow, or if you have debt that you're carrying, looking at your investments, looking about your risk management, things like your insurance, etc. Estate planning, which has nothing to do with estate or palm oil estates, but basically just a fancy word of saying planning for when you pass away, what happens to the rest of your assets. Yeah, your will, trust planning, etc. would all be part of estate planning as well. You would also include even things like tax planning, retirement planning as well. So it's quite comprehensive. So it would cover broad scope. Different financial planners may have different areas of focus or specialization as well. So on my side, because of my interests, will be on the overall financial planning process itself. And then the other major part would definitely be on investment. So, that first love is still there
it's still the
today.
investment part. I feel like there's a big misconception that I think it's even for the like, let's say you say coaching, that you have to pay to get the results, pay for your services. And people might think for financial planning, why do I need to pay you money so that I earn money? It's like, there's no net gain there kind of thing. I mean, starting off, because let's say a student like me, I earn probably with all my part-time job, earn less than $1,000 a month. And there's this misconception. I feel like we have to pay you some more and we don't have enough already. So how do you like, what do you say to that? Like, students, should we get a financial advisor?
Personally, I think having a financial planner is great, for whichever level or age that you're at. The advantage is if you're younger or you're a student or a fresh grad, for example, is you actually have that so much time ahead in front of you, and you don't have all this baggage or mistakes that you might have made in the past. So it's good to actually start out on the right path, actually. I remember earlier I mentioned the misconception that you need to have millions in order to engage a financial planner. Yeah. There's actually a lot of different models that you can engage with a financial planner. It's broadly divided into 3, and then I'll go into a little bit more specific after that. The first model is basically the very old school model where you don't pay the financial planner any fees, but they basically would earn money from any products or solutions that they recommend to you. So they would earn some commissions, but that actually comes from the solutions provider itself. So the pros on that is that you don't have to fork out any upfront money. Financial planner would actually work to have your best interest in mind, just that you got to be careful and to see if the financial planner is really independent and has a wide range of products and solutions, and they're not like particularly representing one particular solution provider, and they're trying to just force you to sell you something. Like a travel agent or something like that, something that you may not really need. So that's what you need to watch out for, and to be aware of whatever commissions there are, etc. So the financial planner should be actually upfront. But generally, this would be, in a sense, although similar, the nearest comparison will probably be, for example, agents, like let's say insurance or unit trust agents or estate planning agents, etc. But the difference would be that financial planner will be more focused on what's in your best interest instead of representing a particular product or solutions company. So that's one model, but they're still pretty old school. So it's actually moved a lot ahead. It's still available, but increasingly unpopular. Because I know you and I, right? For example, or you see anyone, you go to a mall, for example, pre-COVID anyway, when we used to go to malls. Yeah, and then you see people, like trying to push you credit cards or all those kind of things,
Oh
and you
yeah,
just
yeah,
say,
yeah.
hey, no thanks, right?
So
You
I'm
start
still
waiting.
student. I'm not working. Don't
Yeah,
touch me.
that's a good excuse, right?
Yeah.
Yeah, but that's the old school model, but it's still around. And
Mm-hmm.
if you find some financial plans would actually be okay, because they would understand, for example, that maybe you're not in the stage where there's actually a lot to do or implement, or you don't actually need a financial planner 24/7 working with you. So just working on, maybe you have like a small sum of funds to invest, or you're looking for your risk management needs. So at least you would get basically advice which is actually on your behalf and representing you, and really fitting your needs. But
All
yeah,
right.
that's one model. On the second model would be basically what would be known as fee only financial planners.
Mm-hmm.
So these financial planners would be, the closest equivalent would be like you're engaging a lawyer on a
Mm-hmm.
retainer basis. So you'll be engaging the financial planner for a period of time. It can be, for example, for an entire year's period, or some might even allow for shorter durations as well, like on a
Mm-hmm.
per visit or per meeting kind of basis. So you pay them a professional fee. And so basically what you're getting is the expertise and the advice from the financial planner.
Okay.
And for a fee only model, that basically means that there's no commission, sales charges and all that. So if there's any, they would also all be refunded to you. So you're
All right.
purely paying for will be just the professional services. And
Mm-hmm.
then thirdly will be a hybrid or blended model, where there will be a fee actually for engagement. And then on top of that, the financial planners would still have a certain sales charge commissions, but that's paid from the product solutions provider. But it's usually lower cost than what you might have to pay outside. For example, if you manage a financial planner with our firm, instead of paying sales charges for, say, like things that are okay commonly invested in Malaysia anyway, things like unit trusts, etc., where one of the key issues about unit trusts, or one of the concerns that many people raise, is the high sales charges, where you might be paying 3, 5, 6% sales charges, etc. So the moment
Mm-hmm.
you invest, you already have your capital reduced a little bit because of the
Yeah.
sales charges. But by working with financial planner, the sales charge can be as low as 0%. So you
Mm,
invest,
okay.
say, 1,000 ringgit or 10,000 ringgit, the full amount gets invested. So that's good for you
Mm-hmm.
as the
Yeah, yeah.
investor. Yeah, yeah.
All right. As okay, since our let's say my audience is students, mainly
Mm,
students, and these words get thrown a lot. Financial literacy,
right.
right? But it's very vague. How do you define financial literacy? Like how would I know if I'm literate? I know to save money, I know not to spend on stupid stuff. But what does it actually mean by being financially literate?
Sure, that's a great question. And this year itself is actually, we are celebrating financial literacy year. So there's actually an initiative called by the Financial Education Network. So it involves parties including the Securities Commission, Bank Negara, the Financial Planning Association of Malaysia, etc.
Mm-hmm.
Basically to improve financial literacy. And the key group or most important group would actually be the youths, basically the people who will actually make the biggest difference in tomorrow itself. So for me personally, financial literacy is it's actually a journey. It's not like a point, but it's actually a journey that you would embark through. So it would be basically a journey knowing how would you reach financial independence. So you can actually break that journey up into 7 stages actually towards
Mm-hmm.
reaching financial independence. The first stage, or actually stage 0, is financial dependent. So you're actually dependent on your parents when you're born, and you're young, or you're getting pocket money, etc.
Mm-hmm.
And then after that you move to actually the first stage, which is financial solvency. So that's when you at least have some income coming in. It can at least cover for all your basic expenses, living
Mm-hmm.
expenses, your bills. And then the second stage would actually be financial stability. So this would be when you can actually build up a buffer fund,
Mm-hmm.
say 3 to 6 months worth of your expenses. So you know that if anything happens to you, you would have that funds available. Moving on, the third stage would actually be debt freedom, when basically you are
Actually,
totally debt free.
you mentioned. I think this is a fourth already. You mentioned.
Yeah, because the first stage is stage 0 actually.
Oh,
So if you
okay.
exclude stage 0, yeah, that's
Oh,
very
all
good.
right. Yeah, yeah. Got it.
Yeah,
I
good
was
that you caught
confused
that
for a
as well.
while.
Yeah.
Yeah, yeah.
Yeah, so as a recap, yeah, stage 0 is financial dependency. Stage
Mm-hmm.
1 is financial solvency, when you are able to cover all your expenses.
All right.
Stage 2 is financial stability, when you have
Mm-hmm.
your emergency funds or your backup funds set up. Stage 3 is debt freedom, when you are able to clear off, all your debts, your education loan, etc.
Mm-hmm.
Stage 4 is financial security, when basically your passive income or your semi-passive income can cover 100% of your expenses. So you're fully secure at this stage. And then stage 5 is financial freedom, where you basically have everything financially stable. You have the freedom of time as well as monetary side to pursue all your passions and spend time with the people and purposes that matter to you.
Right.
And stage 6 is financial independence, where basically your passive income, semi-passive income can cover 200% or twice all your expenses. So basically at that point of time, technically you could choose not to work if you desire. You could choose to fire your boss, or you could do whatever you like, basically.
Right.
And your funds will continue to grow because your wealth is growing at a faster stage than your expenses.
Right.
And the last stage, or stage 7, would actually be financial abundance. So this is the most difficult stage, but can be the most rewarding as well. So basically at this stage where the focus would be no longer on you, but basically about making a difference, leaving a legacy to people around you. So while it actually flows in this stage as well, it doesn't 100% have to flow linearly at this stage as well. You can already do some elements of it as well. So even like even though you've just started working, if you have some additional funds, there's already opportunities for you to actually give back to society, give back to those in need as well. Yeah.
Like I actually heard this this saying that money, the more you give, the more you get. It's the same. It's like karma like that lah. And like they said, appreciate your money. What do you think that means? Like, there's this video on the thank you economy. So basically, I don't know if it's thank you economy or something, but basically every time you spend something, you're grateful for the money. It's like mindful towards what you're spending. Yeah.
And
So
that's an important concept to keep in mind as well. So basically money, I'm not sure in school or elsewhere, you might have, or, forced to do assignments like, oh, money is the root of all evil, is that true or false, that kind of things. So at the end of the day, we all know the answer to that money is purely just a tool actually.
yes.
So with a tool, it's more of the intentions behind the tool, behind money itself. So if you're treating money as it can be in extremes really. If you treat money as something that totally has no value, you don't care about it, and you just burn it and spend it without a care, that can be dangerous as well. Because you actually don't value the resources that are put in and how it generates as well. On the other extreme, if you're too stingy about money, holding on to it like you say, just grasping it so tight, then it's also dead as well, because it's worthless until and as and when that is actually
it doesn't flow.
spent. It doesn't
like
flow.
stagnant water.
Correct. And that's that cascading effect when you look at it from an economic level as well. That same, say $100 that you spend, and then the next person use it to spend as well. So from that same $100, when it actually flows, then it actually has a recurring effect on the economy as well. How it actually cascades around and basically drives up economic activity on the whole.
Yes, so if you're listening to this and you study economics, you probably will understand this. If you're in psychology, like I think most of my audience are, you can go search it up. It's very interesting on how the mindset of how you use your money. You can search that up. All right, so now let's talk about students. All right, there's some myths that we have to debunk. And okay, so first of all, what's the most common financial mistake you see students make, or like say youth make?
Sure. I think the first most common mistake would be basically, especially all the while, if you have actually been dependent on income, and then you suddenly go to college, uni, maybe you're working part-time, and hey, you suddenly have source of income coming in, right? Yeah. Or maybe you suddenly get a much larger allowance. You're no longer, like a little kid, given allowance on daily, weekly basis. Like, hey, you're on your own. You got a couple thousand suddenly in your hands, and it's very easy just to go, a little bit crazy with that, having a larger sum. So these lessons actually apply whether you're young or old as well. Similar if someone you're old and then you suddenly get an inheritance of say $1 million, or from your EPF money, which you can't touch until you're 55, suddenly you get a large chunk of money and then you just go crazy. So it's good that these concepts are actually learned from young. How you can actually handle even smaller sums of money. So, it's that same lesson that's going to bring you forth, in your later stages of life, when you actually have a larger amount of funds as well. So back to the major mistake, number one would actually be basically your lifestyle. In some countries, they call it doodads actually. Basically, they call it a doodad because, you're basically buying things that don't really matter or not important to you. So, you don't even have a name for it. It's just a doodad, a doodad,
Oh yeah, okay.
just random
It's like
stuff
what
that
society expects you to do with your money, kind of thing.
Yeah, it can be peer pressure as well. Seeing someone with the latest Jordans, etc.
Yeah,
Or the latest
the
tech
iPhone.
stuff, iPhone 12,
Yes.
etc. And just trying to keep up with that. Yeah, so
Yeah.
overconsumption would actually be one of the major issues as well. So it's okay actually to spend, and I'm of the thought that you should actually spend on what you like, what you love, whether that's getting a gaming rig, if that's your thing,
Yeah.
eating out, if you're a foodie, etc., traveling, etc.,
Yeah.
pre-pandemic anyway, or whatever you like.
Yeah.
But basically the idea is that cover all your expenses first, and then choose and pick what are the things that are important and matter to you. It can't be everything, right?
Yeah.
So you can't be frivolously just spending, but pick and choose what are the things that you want to spend.
But how would you say that the point between where you're spending and treating yourself and overspending? So how would you differentiate between that two? Because I could spend a lot, then I would say I'm just treating myself, which is good, but in some other people's eyes, you might be spending a bit too much. That kind of how do you differentiate? How do you know when is the cutting off point?
For this, usually ratios kind of help. So ratios are not set in stone, but they're kind of like a good rule of thumb. So basically, you would look at, okay, what's all your income coming in? So that's 100%. So a good rule of thumb would be to keep 1/3 for basically all your expenses. Keep a third for savings or investment, and then a third for your wants. So as long as you keep it within the thirds, the rule of thirds, then you'll be pretty all right, because you'll be meeting your savings goals. You'll be making sure you cover your expenses. You wouldn't be like hey, you have the latest PS5, etc. But then every day you're eating cup noodles. So that's gonna have long-term repercussions on your.
So as long as you can keep your expenses, you're basically what you have responsibility towards yourself, you can go crazy with the rest. That's the general rule.
So like when you hear about tracking a budget and all that, very legit, right? But the whole idea actually of a budget is to actually free you. Then you set aside a third for your savings, a third for your expenses, and then you can go crazy with the rest, and you don't have to worry about it, because all your goals are being met, and you're still within your spending pattern. And it leads us to a point. So the problem with that is then when you get access to this piece of plastic which allows you to spend more than you have.
Yes, actually, I was gonna get into that. All right, yes, since you're there already, go on.
Sure. All right. So credit is a double-edged sword. It's fantastic if you do it right. I'm of the belief that if you know how to pay off your credit card balance in full, it's fantastic. You get cashback or vouchers. It helps you build your credit score. So there's a lot of pros to that. But the double-edged point is when you don't clear it off, and then you get
it piles up.
It piles up, especially you pay the minimum, and it doesn't even matter then. If you're basically carrying debt, especially credit card debt, the first thing that you do is really you just want to clear that off in full. Because if you don't, even if let's say you're investing and hey, your investments are doing pretty well, say you're doing 10% plus per annum, but on the other hand, your credit card is charging you 18% per annum. So because of your debt, it's actually dragging you down. So that's why clearing off debt is really important.
But let's say if we have a choice, should we get a credit card as students? Because I've been hearing you should probably get a credit card, it'll boost your credit score. But yet again, a lot of people are not that responsible. How do they spend their money, especially at our age? So what would your recommendation be? Is there like a criteria you have to meet for yourself to be able to like just own a credit card?
Right. I think it will really know about yourself and your spending habits. So I can provide some general guidelines. One is just to get one card, not more than that.
Okay, yes.
You can actually, select a card which has a lower limit, or even request for a certain limit as well. So that, okay, let's say the max spending should be, say 3 months or maybe 6 months of your income. So say if you're earning 1,000 a month, you can get a card which gives you a limit of 3,000, 6,000. So even in the worst case scenario, you just have to be able to save up for 6 months to dig yourself out from a hole.
All right.
But if you're not sure whether you can actually handle that responsibility, hey, just go with your debit card first. Because debit card would then be spending money that's already in your account that you already have, and you don't have to worry about going negative and having to repay that back. And our debit cards come in both Visa, Mastercard variety, so it already gives you
if it's zero
that
means
handiness. If it's zero, that's basically zero. You can't spend. So that just puts you on a halt. For the credit scoring part, it's actually not that important, especially once you're a student, etc. It's actually more important in overseas countries like in the States, etc., where it's really important to start building a credit card score even from as early as you can. Over here in Malaysia, it matters a little bit, but not that much. So it's not a deal breaker. You don't have to purposely get a credit card just because you want to build up credit score. So don't worry too much about that. It should just come naturally once you're actually fully working, and then just get a card and you're fine.
All right. Okay, so actually just now at the start you mentioned your first interest was in investing, and a lot of us young people, we like to invest because it's the cool thing. You see stocks, you see this kind of investment returns. Everyone's the rich, very rich, and like you see on social media, all these stock gurus, they have this sports cars, this nice phone, nice bags. What do you say to that?
All right, so there's a couple parts to that. I totally understand. Even for many people, investment is being viewed as the dark side, the sexy side of things, right? That catches most people's interest.
Because people don't want to be just saving and just get your FD 1-2%. They want to see the 10-20% kind of returns kind of thing.
Correct. With that said, though, I would be a little bit cautious with investment gurus out there, because there's a lot of investment gurus that are actually unlicensed, and to actually see whether do they really have a track record, or is it they're just really good salesmen, where how they actually make the bulk of the money is by selling courses actually, and not through what they do. So you really need to find someone who actually walks the talk, and it's really doing that. So that's it on the investment guru side. With that though, it would also depend on your interests as well. So for some people, if you have the time and the interest, it can make sense to start looking at investing into, say, individual stocks and all that. It requires hard work. You will make mistakes, or you pay tuition fees to the market when you plan but on the other hand, there can also be more passive investments as well. And basically, investing is just so much more accessible nowadays with fintech, financial technology in the picture. There's so many robo-advisories, more portfolios available as well, where you don't actually need to go to the extent of doing individual stock selection. That you can actually use a robo-advisory or a fintech solution in order to start accumulating and start investing. And it's very accessible as well. Most of the time, less than 1,000 ringgit, or even hundreds of ringgit, you can already get started.
I saw this app. It's called Stash Away. Have you heard about it? I think you definitely heard about it. It's called Stash Away. What do you think about that? Because that's what you call a robo-advisory, right?
Correct. That's right. Yeah. So there's basically 4 licensed, if I memory recalls me right, there's actually 4 licensed robo-advisories here in Malaysia. Stashaway was the first one to launch in Malaysia, originally from Singapore. Although their chief investment officer is originally is a Malaysian as well.
Okay.
Right. So those will be examples of robo-advisory. So the whole idea is that most robo-advisories are actually investing with the use of algorithms in order to do what tech does best, which is crunching large amounts of data and numbers. And the underlying asset behind that would actually be exchange traded funds, or ETFs. So basically, what a robo-advisory does is it helps a little bit with the asset allocation. So in order for this to make sense, I need to talk a little bit about asset allocation. So there's basically 5 major asset classes. The first you'll be familiar with will be things that are cash or cash equivalents, things like your savings accounts, fixed deposits, money market funds, income portfolio. All that will be falling under cash. Secondly, will be fixed income. So this will be things like bonds or Islamic bonds, so-called fixed price funds, etc. Thirdly, will be equities. So this will be things like shares, equity funds, so that would be equities. Fourth would actually be properties. So this would actually be actual investment properties or commercial properties or land or real estate investment trusts, if you've heard of that. So that's another way to invest into property as well. And fifth would be alternate asset allocation. So this would be things like gold, silver, commodities, cryptocurrency, peer-to-peer lending, equity crowdfunding, all that will fall under alternates.
Others.
Right? Others, basically, yeah. Yeah. So the robo-advisory part, it usually focuses a little bit of the mix between equities as well as fixed income, and maybe a little bit on alternates as well. Typically, gold, which is the most accessible commodity. Yeah, and acts as a little bit of portfolio insurance or hedge in times of crisis. Yeah, like what we actually saw. Gold has actually rallied quite a little bit this year as well, as we saw the pandemic unfold. So basically the whole idea is with Roboadvisory, or actually a managed portfolio, is that it actually gives you an allocation into various asset classes, and it tries to select, which are the countries, which are the sectors, and what will be the allocation related to the amount of risk that you're willing to take. So if taking something more aggressive, then you have a higher weightage into more equity focus and a lower weightage into fixed income or bonds. And likewise, if you're more risk averse, then you have a higher weightage on bonds and lesser into equities.
So in general, how well does this robo-advisory perform?
So in general, the performance would be basically they're doing the asset allocation for you. So it would give you a market average return. Yeah, and then the fees, because of that, they don't need a lot of manpower, because they basically use more tech, so it's easier to scale as well. So they can keep fees low as well. So typically for this, annual fees will be, if you include plus some of the other hidden rates, forex, etc. costs, would be probably between 1 to 1.5% at most. And if you invest a larger amount, that numbers can come down a little bit as well. Yeah. So the question to that is, how does that compare towards individual stock picking, for example, or any other particular focus? So technically, if you are able to perform above market rate returns, you have the knowledge, the capability, or you can find the right fund managers that can do better than the average market performance, then yes, you'll do better on your own. Yeah. But so there's two schools of thoughts. The robo-advisories, because they are biased, of course, towards their own products and solutions as well, is that the average investor, the average fund manager cannot beat the average performance. So they're proposing the average performance to be, what you should be aiming for. Yeah. And there are those, who still are able to outbeat the market performance, whether they're individuals or
hedge funds,
or fund managers, hedge funds, etc. Yeah.
All right. So would you recommend, let's say I'm a total beginner in this, and I want to start investing, because you said the 1/3 rule, 1/3 goes into like investments and savings kind of thing. Should I put my 1/3 into this kind of robo-advisory as like a starting point if I have no knowledge whatsoever in investing?
All right. Probably not the entire 1/3, but that 1/3 you can further allocate it down or break it down as well. And remember, I talked about having asset allocation in all 5 asset categories, from cash to equities, bonds, property, as well as alternates. So into robo-advisory, in my opinion, a good percentage would be 10% of that 1/3 to go into a robo-advisory. That would be actually a pretty healthy amount. While you can still then allocate some of the other funds into the various other asset allocations as well.
All right. Since you talk about 10%, and easier for us, we just talk about percentage out of the 1/3. All right. So we have to differentiate this 5 allocation, right, of the asset classes. So how would you allocate that 1/3? How many percent goes into each?
Sure. So usual ones would be for cash, you want to keep about 5%. So that's usually a good range. That's for the lowest risk, which is basically cash
as
and
in
cash
like FD or like
FD, money market funds, income portfolios. Yeah, all that will fall under cash. Higher savings accounts as well. There'll be a cash alternative. So at the lowest risk, 5%. So at the highest risk will be alternates, things like gold, cryptocurrency. And cryptocurrency. It's a lot of fluctuation. It's definitely not an uptrend right now. If you bought crypto.
I was in it 2 years back actually. Yeah, and it went up a lot. Then after that, it just so yeah.
We all remember that. Yeah, when for example, probably Bitcoin, which is the one that most people are familiar with. Yeah, it peaked, then it crashed. But there's certain market elements that are moving the crypto markets today as well. So even for the alternates, 5% will also be a good allocation to that.
All right.
All right. So that's 5 and 5. So you have another 90% left.
All right.
10% is a good allocation for property, whether that's actual physical property. But physical property is not for everyone as well. Property comes with its own set of headaches as well. Managing your tenant, or if you're doing Airbnb, you still need to manage that. Or if not, you need to outsource that to a third party and you have to pay them as well. So there's costs related to that as well. And property is not cheap as well if you're buying physical property, right? So quite often Malaysians end up holding too much property, and then actually this
the
year
cost to
especially,
maintain, right?
the cost to maintain, the cost of the loan as well. So that's actually causing a little bit of distress for some Malaysians, especially if you bought too much property, and then if you were not able to get a tenant, for example, then you would have issues as well. So that's why being overly allocated can be an issue as well. For example, you bought a property, let's say near a university or a college, and then the uni or college is closed because of COVID, and then you don't have your tenants, and yet you still have to pay, your property loan. So there's a cause of concern as well. So you've allocated 5, 5, and 10, so that's 20%. So you have another 80%. All right. So for this 80% would then actually really depend on how much risk that you want to take. So it can go, up to say 45 or 50% into equities, and then the remainder 30% into bonds or fixed income. Or it can be the other way around, where you might go up to 50% in bonds, 30% into equities. But you shouldn't miss out any of the asset classes, because by properly allocating the asset class, it will actually perform during different economic times as well, whether you're in a growth stage or you're at a peak, or the economy is actually tanking, or you're in a recessionary environment. So the whole idea is that the portfolio, by having different asset classes, will perform better, no matter what economic condition that you're in.
Yeah. All right, cool. So we just recap: 5 into cash equivalents, 5 into others. You have 10 into your real estate, and then 50 and 30 is up to you between your bonds and your equities, right?
80%. Right, cool. So you could do 40-40, or any other.
Up to your risk tolerance.
Up to your risk tolerance, that's right.
All right. So cool. Thank you so much for the advice on investing. I feel like this will benefit a lot of people, especially as students. We don't know, we finish our studies, we don't know what we want to get in. If you listen to this, you don't understand, rewind back and listen to it again. Listen again. It's going to help you a lot. All right. So how can young adults, one of the last few questions, how can young adults be more financially literate? Like,
sure.
How is there anywhere we can go? What should we look up for?
Great question. If you're talking about where to look out for, there's time for me to plug my own site. So head on over to mypf.my. So feel free to share the link with the
listeners. I will do it.
mypf.my. So we have more than 1,000 plus articles actually. So technically, if you can, we also have an archives page. Basically, if you read every single article, I would already say you're already within the top 20% of financially literate.
It's like a course on its own.
It's like a course on its own. But beyond that as well, it's really about, investing in yourself. So the best investment, definitely, especially when you have a longer time horizon, being a young adult, etc., student or fresh grad, etc., is really spending, investing in yourself, whether that's going for courses or even free materials, resources, just spending time in growing your own knowledge in the area of personal finances. And there's just so many, free, wonderful resources. Just need to Google, or, the second largest search engine, just need to YouTube, and right now we're seeing content even created on other platforms as well. Instagram, TikTok, surprisingly, also has
I've been seeing a lot of financial content.
Content, right? So, there's a lot of resources. So up to you how and where you want to consume others. Secondly, would be to basically learn from other people's experiences. You don't have to make the same mistakes other people do, and see the things that they have done. What are the mistakes? So that's good experience that you can get from there. And the third part would be to have your own skin in the game. So you can start small, but nothing teaches a lesson better than when you have your own money and your own resources put into it. It makes a world of difference.
The hard way. Yeah. All right. Actually, just now you mentioned go to courses, right? And how do we know which courses are good? Like which who do we listen to? Because there's so many courses out there. How do we differentiate the good ones from the bad ones? Or just like you say, some of them are very good at selling their courses, but not exactly teaching you how to invest. How do you just gauge what is right?
Right. Um, Most of the time, those who are really passionate about just teaching in general and sharing information,
Mhm.
you'll find that it's surprisingly actually free or close to free actually, because their
All right.
motivations wouldn't be actually to make money during the process as well.
Mhm.
So whether it's online media or even books,
Mhm.
actually whether ebooks, physical books, because when people write books, books actually make very little money. If you're if you're an author or you write a book, so most of the time when people write, it's really because they have something that they want to say, they want to share,
Mhm.
and they want to pass down and for other people to learn and grow. So yeah, those are some of the best
And since
investments
you're
that you
here,
can make.
what
Mm.
what what books do you recommend? Are there any specific titles which are really good for people to get into?
Specific titles, it really would depend on your
On the
area
person,
of
right?
focus and
Okay.
interest as well. So also the type of ways that you learn as well. So for
Mhm.
example, if you learn more through stories, there are some personal finance books that are written more in story form, while if you're really like hardcore into uh,
Technical stuff.
technical fundamentals, which may be a difficult read as well, there will be things that are written, for
Mhm.
example, like The Intelligent Investor by Benjamin Graham, which is basically Warren Buffett's mentor.
I
But it's
have
not an
that book.
easy read, I
I
tell you.
haven't I haven't finished. I read the first few pages. I'm like, what is this? I've been saving it for some other time.
Yeah. So take your time and slowly digest it
Okay.
through as well. Yeah.
All right. So I guess we are towards the end. It's been 45 minutes. It's been a good session.
Wow.
Yeah. Final advice. What can we do as youths? Any final advice on that?
Sure. So if you were to summarize everything that's to do with personal finances, into
Mhm.
just simple concepts, no matter your age or your experience, etc. The whole idea is actually number one is you need to increase your income,
All right.
whether and frankly the best rate of return is actually on yourself actually, whether it's getting that
Yes.
promotion or getting a better job, or in the
Learn a
business that you're
skill.
doing, learn a skill. Yeah,
Yeah.
that actually makes the biggest difference, more than just about any investment that you do.
Mhm.
Of
Yes,
course,
definitely.
investments can be part of increasing your income as well, so that's
Mhm.
number one. Second is to manage your expenses. Remember we talked about
Okay.
the third, into
Yeah.
expenses, and then the third into bonds. So if you're really serious about building wealth, you need to be saving, investing at least 40% of
Mhm.
your income. So your ETF, for example, if employed, that will cover maybe about 20%. So then another 20-30%, would need to come from your own savings.
Mhm.
So that's number two, is manage your expenses. The third would be actually to avoid making major financial mistakes. So if something sounds too good to be true, and then you
It's
put
too good
all
to be
your
true.
money, yeah, it's too good to be true. And a major financial mistake can actually set you back tremendously. It might have an effect on your confidence as well. So
Okay.
those are things that you want to avoid. And the last one would basically be to invest the difference between your income and your expenses.
Mhm.
It's a little bit cliche, but compounding really is the eighth wonder of the world, and it
Yeah.
just continues to build actually, and especially when you have a duration. So a way of
Mhm.
looking at it is that if you wanted something that would return 100 times, and you have
Mhm.
say 25 years, simple math. This is not really even with compounding. You would just need a 4% return times 25, and you
Yeah.
would actually uh, generate that kind of returns as
Returns.
well.
All
Yeah.
right. Okay, thank you so much. So if you guys want to learn more, definitely go check out his page, mypf.my. Am I right?
That's right. Yeah.
mypf.my. And also just you can search him up, Stephen Yong on LinkedIn. It's Stephen. All right. I will put all the links in the description, and you can easily find it. Um, yeah. So thank you
Uh,
so much for coming on today. Is
sure,
there
sure. I
anything
had
else you
I
want to
had
add
a
on?
really an awesome time, and hey, I really think that we should do something special for students, and I
Yes.
do understand as well where you may not have a large sum to start off
Mm-hmm.
with. Uh, so you know what, this is just impromptu, I can
Alright.
actually throw in, actual meeting with a licensed financial planner such as myself,
Alright.
from as low as actually 300 ringgit, and hey, I'll even throw a 10% off on top of that. So for that amount, less than 300 ringgit, you basically get to meet a financial planner. You will get a whole financial plan for yourself, and you
Alright.
also will get to ask questions as well. Let's say even like you were looking at courses or what things next to do or what to invest in, or you're not sure what's the weightage between your equities, bonds, and your investor risk profile. Yeah, all
Basically
that
look
can
at your
actually be
whole
answered.
financial
Yeah, basically
outlook
look
of
at
it.
your whole financials. Yeah.
Alright, so if they are interested in it, they can just hit you up on LinkedIn or
I'll drop you a link after this. So
yeah, okay,
people can
that's
just put a link, and with the mic'd up
alright, yeah,
name
so
on it. So I'll
just
get
click on
a
the
promo
link.
code for you guys. Yeah.
Alright. Okay, thank you so much. And I guess this is the end of our podcast. We'll see you guys in the next one. Thank you so much, Steven.
Thanks, Elton. Thanks all.
Okay, bye. Alright, so that's all for today's episode. Subscribe to us on YouTube. Drop a follow on Instagram at MicedUp, MICED_UP. Take care, stay awesome, and we'll see you guys in the next one.